Intercompany transfer of assets. Upstream sale of non-depreciable assets, land. And this year we're looking at year 2 and beyond, and we'll address the equity method of accounting and consolidation accounting together, since there's not a lot of activity taking place after the transaction occurs. Here's the information. The parent continues to hold the land and does not sell it until X4. The activity between the parent and the sub, obviously we have net income and dividends, but we're going to specifically address the sale of the land, and there's no activity in the second year because the transaction took place in year 1, so there's really nothing to do in year 2 or 3 until the parent sells the land, and we'll address that in year 4, and we see that a few slides ahead. What we do have to address, though, is the eliminating entries. And anytime we make an EJE and there's a gain or a loss or some type of transaction involved with it, and it's still there, we have to address it in future years. We also have to know that anytime we have an asset or liability account and we make any adjustments to it, we're going to have to continue to make those EJEs into the future because those entries never post to the parent or the sub's records. We know that there was a deferred gain, and we know that the land was overstated, so we need to reduce the value of the land. So, what did we do in X1? This is the entry we made in the first year. Debit gain on sale, credit land, to eliminate that and bring the land to its correct value. Well, where do revenue and expense accounts go after they close out? They go to the investment sub account, and if the transaction is upstream, it will also be allocated out to the NCI. So if we take the EJE from year 1 and use it as our starting point for year 2, and we know that the revenue and expense accounts get closed out, we can reallocate or rework the entry to take the gain and reallocate it out to the sub and to the NCI at an 80 and 20% ownership level that they have. The land will stay there as a land because we still own it, and it's overstated, so that entry will bring the land down to its current value. And this is all the entries we will need to make relating to the land for the second year. Well, we now arrive to the 4th year when the land is sold by the parent, and the land is sold by the parent to a third party for $320. That leaves the parent with a gain of $189, and the parent would make the following journal entry. What that does, though, is it allows the deferred gain that took place from year 1 to be recognized. And as the parent records their current year activity entries for the dividends and net income, they know that there was a special allocation item or deferred gain that can be recognized now. So what we'll do is, once we know this, we will recognize it as part of the income from sub. So we'll debit investment sub, credit the income for the deferred amount, $89,000, times the ownership percentage that we have, which is $71,200. We can now begin the consolidation process, and we'll start with the special allocation items, which is the equity method entries that we made. And this is the entry we saw that we just made, 80% of the gain. One thing we need to remember is that when we have an equity method entry like this, and we're going upstream, when we make the elimination, we need to consider or assign the NCI their value. So what we're going to do is we'll break this down into 2 parts. The first being eliminating the income from subsidiary in the investment sub, and the second being assigning to the NCI their 20% portion of the deferred gain. So we'll debit income to NCI, credit NCI. At this point, we've eliminated any deferred gain through the equity method. We've assigned it to the NCI. But what we have to do is we have to properly assign any gain, any deferred gain, to the NCI and the parent. Now, this is the entry that we made in year 2 and 3 to bring the land to its correct value and to defer a portion of the gain. What we know is that the two debits can stay, but the land is no longer there. We have sold the land to some third party. So what we're going to do is we're going to rearrange or reclassify and remove the land and credit gain on sale of land, which will bring to income the full $89,000 that we had deferred in year 1. So if we clean that up, we'll get this. And by doing this, we bring $89,000 into income, into consolidated net income, which recognizes the full amount of the gain from the beginning of the transaction way back in X0 through now to X4. Here's a recap of the two entries that we just did. And when we do consolidated net income, the one thing to remember is that in X1, we subtracted out that unrealized or deferred gain. When we sell it in X4, we're going to add it.